Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Sonia Shenoy. And Sonia, it looks like it's turning out to be another very quiet, range-bound session for our markets. We have been respecting the range of 18,000 on the way down to 18,350. That's acting as a bit of a resistance for our markets on the way up. So we are very much in that range. And volumes too have dried out and thinned out considerably. Like yesterday, the FI gross volumes were down nearly 40%. And tomorrow, US markets are shut for Thanksgiving. So, volumes are on the lighter side. And that usually can result in big moves, especially in individual stocks. And that's what we've been seeing. Talking about cues, the Fed minutes, as we've been highlighting, will be on our radar today. This is also the expiry week. The expiry is tomorrow on Thursday, but in the run-up to expiry, we will watch for usual stocks like HDFC Bank, etc., which have their moves. And of course, tomorrow, as I said, it's an off in the US markets for Thanksgiving.
Absolutely. The volumes are on the lower side, but you know what? That's not stopping the banks, right? I mean, just look at the PSU banks. Once again, huge rally is what you're seeing there. So many of these PSU banks are sitting at fresh 52-week highs and 5-7% moves. Punjab National Bank, Karnataka Bank, in fact, all of these, Bank of Baroda at fresh 52-week highs as well. So this is one rally that has not stopped at all. And the other space that has been on investors' radar once again, of course, is defense, and there too the rally continues. So these are themes that have played out and played out pretty well, and that's something that the street definitely likes. But let's get straight to individual stocks then. This morning, one of the big movers is Zee Entertainment after the TRAI has announced the implementation of the new Tariff Order 2.0. Vaishta is here to tell us what this means for Zee Entertainment. Vaishta.
Hi Sonia. Well, TRAI has made some amendments to the new Tariff Order 2.0 yesterday, and as per the earlier new Tariff Order 2.0 version, the pricing on the channels which are forming a part of the bouquet were capped at 12 rupees, which is now being changed to 19 rupees. Also, as per the earlier NTO 2.0 version, there was a capping on the discount of 33% for bouquet prices versus the sum of a la carte. But as per the new Tariff Order 2.0, which was announced yesterday, the broadcasters are now allowed to offer 45% discount. So there's some positive for the broadcasters. Now we have to wait for the implementation of this new tariff order, which will take place by February 2023, which will be the key. Also, the channel pricing list, which is required to be submitted by 1st of Jan 2023, which is to be watched out for. Nuvama feels that NTO 2.0 implementation is positive for all the broadcasters in the industry, and they expect good recovery in ad revenues for Zee due to the improving gross margins for consumer companies. So net seems positive for the broadcasters, as the subscription revenues now have the potential to improve, especially in a weak, subdued advertising environment. We also recall that Zee's advertising revenues were down 7% in Q2 of FY23, while the subscription revenues were modestly up by about 4% in the same quarter. So all in all, seems a positive for the broadcasters.
Thank you very much, Vahishta, for highlighting that. To discuss all these developments and what they mean for the broadcaster space and Zee Entertainment in particular, we're now joined by Abneesh Roy, the Executive Director of Institutional Equities at Nuvama Wealth Management. Abneesh, thank you very much for joining us and taking the time out. First, your thoughts. What are the big changes, according to you, and the implications for the industry?
Yeah, thanks. Definitely, this is a positive development for Zee and other broadcasters. So we maintain a buy. So essentially, regulator is giving freedom to the broadcasters to do the package, do the pricing, etc. Last 3 years, if you see the subscription revenues in India for all broadcasters and for Zee in particular has been quite muted. Now what will happen is the litigations will end. So we will see that because of the 45% discount which is allowed in terms of a la carte and package, and of course from 12 to 19 that ceiling is there, we will see more flexibility in terms of pricing. It's good for customer also, definitely. And my sense is, if you look at the subscription revenue for Zee, it's ballpark around 3,000 crore annual run rate. I think this will add around 7 to 8% CAGR every year. Last 3 years, because it was under litigations, it was all on hold. So there was no growth. Whatever growth was coming, that was coming from Z5 and the other music revenues, etc. Now this will become like a 7 to 8% CAGR. So on a 3,000 crore kind of subscription revenue, we expect a acceleration further on that around 7 to 8%. So this adds a 250 crore kind of a revenue in the first year. My sense is this will not be too much of incremental cost because already teams are in place. So let us assume say 80% of this flows. So we are talking about a 200 crore incremental EBITDA on a 1400 crore kind of EBITDA, say, for this year. That's our expectation. Next year, our current expectation is around 2000 crore of EBITDA. So there will be upgrade of, say, 200 crores. The good thing is the regulator is giving 2 months to prepare also. So they are preponed from February end to February, start of February. So that will again give them the time to prepare for this. Plus, advertising revenue will definitely recover in H2 and FY24.
That's what I was coming to, Abneesh, because, you know, at a time when the advertising revenues are so weak, right? I mean, just look at the stock. The stock is down about 20% if you look at it in the last couple of months. You think this news is enough for the stock to recover? Because the management as well said that the advertising revenues were not only weak in the quarter gone by, they have no expectations for a major improvement in the second half either. You think this news flow is enough to perk up the stock?
So three things. If you see, Z is going through a merger process. So what will happen is in Q4, you will see the Z Sony stock going through the merger process, and the Z stock will be delisted for around 5 to 6 weeks. So it's a technical reason. Some investors are taking that into account, that why should I take a risk of that 5 to 6 weeks? But post the merger, if you see, it will become almost double in terms of size, revenue, EBITDA, etc., and also much higher liquidity. And merger benefits, if you see 4 to 6% revenue synergy benefit of Z will definitely be there. So I will say that the technical reason could be part of the reason why the stock is not reflecting. Now on your bit on advertising revenue, if you see, we had this HL analyst meet also. So clearly we will see across the board FMCG companies worst is behind in terms of margins and volume growth in the rural. See, rural anyway, now base effect will happen. So even if the structural recovery in rural is still awaited, because winter demand as of now is looking good. So skincare, Chyawanprash, honey, etc., there is a demand pickup also. Plus palm oil price is now half. So in terms of packaging cost, which is linked to crude oil, again, that is down from the peak. So I will say that yes, gross margins will expand. FMCG companies will flow back towards advertising. It will happen gradually. Q4 should be a very good quarter for advertising, and FY24 should see a further build up on that. So yes, it's a gradual process. But what we are seeing is gradually everything is coming together in terms of advertising, subscription. Market share has improved 30 bips. And because rural recovery should also start at some juncture, the free dish, which was there as an overhang because customer was taking free dish, I think gradually that should come back in FY24 also.
Abneesh, just getting back to this latest NTO 2.0, the new tariff order, you're saying the new regulations will allow the broadcasters flexibility in their pricing. Can you talk a little bit more about, do you think there is scope for broadcasters to go ahead and hike prices? What does this flexibility really mean for broadcasters at this current juncture?
Right. So one is, of course, because of litigation, everything was on hold.
Correct.
So nothing you could do. Second is 19 rupee pricing is a good pricing. So if let's take example of Z, they have say 70 channels and 19 rupee per channel pricing per customer is there. 19 rupee, there is no problem at all. 12 rupee, there was a genuine problem. That's one bit. Now, second is your predictability and your power to pass on. See, last 3 years, because of litigation, your content cost was going up, but you are not able to pass on to end customer. Now it will become a quasi-consumption kind of a company that you'll be able to pass it on. Pre-NTO issues, etc., if you remember, broadcasters did have a healthy revenue CAGR in subscription. Last 3 years, there is no growth in the subscription. In fact, there's a dip in the TV subscription revenue from the analog TV, etc. The growth was coming from Z5. Now we will see both the growth from Z5 also and from the linear TV also coming back.
So while the ceiling on individual channels has gone up from 12 rupees to 19 rupees, which is a positive, but more subscribers tend to take up a bouquet, right? You always subscribe to a bouquet of channels, and on that, broadcasters can now offer a higher discount of 45% versus an earlier discount of 33%. So net-net, on a blended basis, give and take everything, what is the expectation, on the pricing front?
So, essentially two things here. One is, see, discounting may look optically higher, but issue was because this was on a hold, the 33% was not relevant. So essentially, 45% is a good enough discount because you have so many channels where you can cross-subsidize weaker channels and get good pricing for the stronger channel. Bouquet makes a lot of sense for the broadcaster and for the subscriber. So I don't think you should be worried on the 45%. The 19 rupee increase, that is the key number. From 12, it has become 19, and then you have huge headroom for the next few years to increase. My sense is this should be, first year, as I said, this could be a 10 to 12% incremental EBITDA coming, because last 3 years, there has been no increase at the customer level. So there is general inflation everywhere. So you can take that higher pricing by 7-8% CAGR. And first year we need to see, because there could be some churn initially. This is happening after 3 years. But good part is 2 months of preparation time is there. So I would say that 19 rupees is the important number. That 45% discount is not really much of a thing, because customer will then go for a bouquet. So you are not able to do much of bouquet because 12 rupee didn't make any sense. Now you are able to offer bouquet at 19 rupee, and customer will also be very happy to take a bouquet rather than a la carte.
Okay, finally then, at this 255 rupees price on Zee Entertainment, what kind of upside are you looking at in the next 1 year or so? And would you raise your own earnings estimates based on what you spoke about?
Yes, in terms of earnings, if you see, I discussed the EBITDA number. So there will be an upgrade of, say, 10-12% on the EBITDA on the first year. More importantly, you get a predictability of the earnings from the subscription even after FY24. Because of NTO litigations, etc., that was completely on a hold. Second bit is, of course, in the last 2-3 years, we have had one issue or the other: COVID, advertising, subscription, then all this approvals from the NCLT. Those things are absolutely now mostly getting in place. My sense is Q4, we will see most of the approvals happen, and then 5 to 6 weeks of the delisting will happen. And hopefully by March, we will see the listed entity. So yes, this stock can definitely see a much higher level. So we do expect that in the next 1 year, 2 year, we will see re-rating because of all this. So 30 to 40% upside definitely is possible.
Abneesh, thank you very much for that. 30 to 40% upside on Zee Entertainment over the longer term. Just in the near term, the stock has been an underperformer, perhaps on account of the technical factor, because the stock will get delisted for 5 to 6 weeks before it eventually gets listed as a merged entity with Sony. So that could be perhaps one of the reasons, according to Abneesh, why recently, at least off late in the near term, the stock has been a bit subdued. Get into a break. Up next, we'll discuss what's buzzing in the commodity space. Manisha Gupta joins in next.
Welcome back to Trading Hour on CNBC-TV18. Let's get you a quick update on what's happening in the world of commodities. Manisha joins in, and today we're focusing on silver. Manisha, over to you.
Sonia, thank you for that. With the pullback in US dollar ahead of the FOMC meeting minutes, there is a bit of a risk appetite that we have seen come back in case of commodities. So the metals are doing good. You have silver, which has rebounded from a 2-week lows. So we are almost holding around that $21 per ounce mark in the international markets there. The Indian prices, in the meanwhile, also seeing some support. The support also comes in from stronger fundamentals now, where the markets are looking at a decline in inventories on COMEX and LBMA as well. When you look at the COMEX inventories, well, we have seen them decline by 70% in last 18 months, and the LBMA inventories have continued to decline for a 10th straight month for the month of October. Now, the global silver demand is expected to gain up by 16% on an year-on-year basis as compared to the previous year. And when you look at the global silver deficit, well, that seems to be increasing from 48 million ounces last year to almost 194 million ounces this year. That is the report that's come in from the Silver Institute. They actually have broken it down overall for various categories as well, on where we are looking at a demand which actually is expected at a record 1.2 billion ounces this time around. So the only decline that you have seen in a category is perhaps coming in from photography, but everything else is seen on the higher side. This is the total supply on an year-on-year basis, where you are looking at a deficit in sense of demand supply on both of these years, which really seems to be widening in 2022. As I said, the supply, while has increased by 2%, the demand has increased by nearly 16% on an year-on-year basis. Now, Silver Institute also has broken it down versus various categories, and it's only in the photography that you have seen the silver demand decline on a year-on-year basis. But otherwise, whether it's about industrial demand, jewelry, silverware, which is gained up by nearly 60%, or physical buying, which also has gained up quite strongly. We are looking at very strong numbers continuing here. For the Indian markets as well, this time around, the demand is expected to hit a record 10,000 tons. The physical buying and the silverware buying in the Indian markets also is expected to be on the stronger side. One thing that is not doing so well is the institutional buying or the ETF holdings, which have continued to decline and have fallen by a record 110 million ounces in this year. The price view in the meanwhile is not expected to be very strong going forward. Metal Focus expects silver prices to average $21 per ounce in the next year as well. So it's clearly slightly lower than the current year average as well.
Okay, thank you very much, Manisha, for that. Get into a break. We'll come back and discuss market technicals. Mitesh Thakkar of earningswave.com joins us next. Back. The range trade continues for our markets. Right now, we're up close to about 0.1%, 0.2% on the benchmark indices. Mitesh Thakkar of earningswave.com joins us on the show now. Mitesh, you've broadly been cautious in the markets. You don't see too much upside, at least when we've been recently speaking to you. Any trade that you would recommend on the index? And any thoughts on these PSU banks which continue to do well?
Yeah, so good morning, Nima. I think the overall view is still positive, but I think in the short term, it's still a contracting kind of a movement. So last few days, we haven't been trading the index aggressively, though we have taken some positions today. But broadly, it's a market which will need to get past this 18,400, 430 levels to register a fresh breakout. And once that happens, then I think we should clear the all-time highs and continue our upward journey. But till the timing, I think, we're not very aggressive on the long side. On the stock side, yes, we're trading with more of long bias. I have a buy on Steel Authority of India Limited. I think that's breaking out and giving a reversal. So here, keep a stop below 82, look for targets of 86. And fertilizer stocks are buzzing today. So I picked up Fact or FACT. That's a buy with a stop just below levels of 132 for a target of 150.
Okay, that's on sale. What are your thoughts on, I know this is a topic we keep revisiting every day, but there's so much momentum in PSU banks, so you can't really ignore it. For some of these banks like PNB that have had a really good run, Karnataka Bank, PNB, Bank of Baroda is at a fresh 52-week high. Any further upsides that you see in any of these names?
I think, yes, the long-term charts have reversed, and this has happened after about 3 or 4 years for most of these PSU banking names, barring a State Bank of India, which was already in an uptrend. So I think there will be significant upsides. I think the medium-term target which I have for PNB is closer to about 58. So that gives another 16-17% upside left. Though the only thing is that you might want to time these stocks when they give a pullback to the 10 or 20-day averages. I think that's a good entry point. But if somebody's holding out, I think clearly maintain a hold. Similarly, I think Bank of Baroda, my targets here, I think again are in excess of around levels of 210, which was the highs which the stock made in 2014-15. So I think they've started long-term uptrends. They will definitely see higher highs and higher lows coming in the near future, and good to hold them and buy them and accumulate on declines.
Okay, thanks a lot for that. Let's just talk about some individual stocks now. Maruti is the one on our radar. UBS has come out with a very interesting note where they have a rather aggressive target price of 12,000 on Maruti. They talk about how Maruti could be a big winner as the diesel segment derails because there are some strict emission norms coming through. The real-world driving emission norms will go live from April 2023. There's also more stringent norms expected, and that could further increase the relative cost of diesel cars in India, which means that perhaps the demand could move away from diesel, and which is great for Maruti since it has zero exposure to the diesel segment. They're expecting a shift away from diesel, and that could be a big positive for Maruti, and hence UBS has quite an aggressive target price there. But Siemens is also on our radar. Vahishta is here to tell us more. Vahishta.
Hi Sonia. Well, Siemens, which follows the financial year of October to September, declared their Q4 FY22 results yesterday post-markets, and the numbers have seen a healthy growth on a year-on-year basis, but have missed estimates on all the fronts. So the revenues have jumped by 12% to 4,600 crores versus the poll, which was at 5,100 crores. The margins are at 11.1% versus the poll of 12.2%. The order backlog is at 17,100 crores today. And on a full year basis, the revenues have jumped 22%, while the EBITDA margins have fallen to 10.9% versus 11.3% in this last year. Now, in terms of segmental performances, smart infra and digital industries performance has come in strong on a full year basis, while there was a drag in margins for the energy and mobility segments. Now, these two segments are among the largest business verticals for Siemens, and hence there's a drag on the stock.
Okay, thank you very much for that. Just a quick word on the markets right now as we speak. Some of the big movers include Apollo Hospitals, that's the top gainer. Bajaj Finance is higher in trade, that's up nearly 1.5%. A couple of these metal names, so JSW Steel, Hindalco are moving up. State Bank of India has been a rank outperformer. Year to date, the stock is up close to about 31.5%, and that stock too has seen some buying coming through. But on the flip side, it's these new age companies, Delivery, Nykaa, they continue to struggle in trade. These are stocks which are down more than 50% on a year to date basis. And now there is more news, bad news coming in for Nykaa because the CFO, Arvind Agarwal, has stepped down. Manglam is here to join us.
Well, when it rains bad news, it really pours, and that's what's taken place in a lot of these new age companies, and Nykaa is one of them as well, where the last bad news that came in was yesterday evening, where the CFO Arvind Agarwal has tendered his resignation with effect from November 25th. While the release says that he'll be pursuing opportunities in the digital startup space, it is not the first big exit. In fact, in the last 3 months or 4 months itself, we've seen 2 big exits as well, and this is the 3rd big exit in the recent past itself. On November 1st itself, we had the exit of the CTO, Sanjay Suri, and in August, we had the CEO of FSN Brands, which is the private label of the company, Reena Chhabra, resigning as well. And both these people were with the company for almost 6 odd years. And this doesn't bode well for the stock at a time when it's down 50% this year, down 60% from its post-listing high. And that's not all. We've seen a massive sell-off in all these stocks, and Nykaa in particular, as the bonus shares were credited to accounts. And it wasn't just individuals or, HNI selling these stocks. It was actually a fair amount of funds as well who held in from pre-IPO, the kinds of TPG, Lighthouse, all of them selling. So massive delivery volumes on the downside. When everything's not going good, a resignation does not bode well.
Oh, absolutely, it doesn't, and the stock is now down 2.5%. Let's slip into a short break on that note. When we return, Inox Green Energy has made a subdued debut on Dalal Street. We'll be joined by the management to discuss more after a short break. Stay tuned. Welcome back to Trading Hour on CNBC TV18. Well, let's shift focus to the primary market action now. We had a new listing today. Inox Green Energy made a subdued debut on Dalal Street. The stock listed at a discount of 7.5% at about 60 rupees versus the issue price of 65 per share. To discuss the listing, the company's plans going forward, we're joined by Devansh Jain, the Executive Director at the Inox GFL Group. Devansh, good morning and thanks for joining us on the show. I want to first start by asking you about the total debt on your books. Now that the stock has listed, can you take us through what the plan is to bring down the debt post the IPO?
Sure. Good morning, Reema and Sonia. Pleasure to be on CNBC. Sure. So we've got about 790 crores of debt as of 31st March 2022. 370 is going to get repaid by the primary proceeds of the IPO. What that would leave us with is approximately 420. Over the course of the year, we've sold 4 SPVs, 3 to Adani and 1 to Torrent. We've recovered majority of the 100 odd crores which was to be recovered there. What is left for us to now action out is sale of the last SPV, which would be downsold in the near future for about 300 odd crores. So broadly, what we're aiming for is to make this company a net debt-free entity in the very near future.
So when you talk about very near future, from 700 crores thereabouts, how much can you bring it down by, say, in the next 1 year, by the end of FY24?
Oh, within the next 1 year, we'll be zero here. Certainly, we'll be zero within the next 1 year.
Do you think you will be able to action the sale of your last?
No, so out of the 790, as I mentioned,
yes. Go ahead.
We've already cleaned up 370, right,
Correct.
from the IPO. So what we are left with is about 420. 100 odd has already been recovered by way of sale of the 4 SPVs. So what we are left with to clear up is roughly 300 odd crores. And that will get cleared by sale of the last SPV. So we've already sold 4 such SPVs, 3 to Adani and 1 to Torrent over the course of this year. The last SPV is also expected to be sold in the near future. And with that, Inox Green becomes a net debt-free company.
Do you think you will be able to sell the last SPV before the close of this fiscal year? And who are you in conversations with? I mean, how far have the negotiations proceeded?
Look, I'm sorry, I can't give... Look, frankly speaking, I think we're in touch with multiple parties is all that I can say. Okay. And given the fact that we've already downsold 4 SPVs, it's a fairly straightforward job selling the last SPV of 50 megawatts. It's not rocket science, frankly speaking.
Okay.
I think
so
we should be done with that very soon.
You're confident it will help you net 300 crore rupees, right? That valuation, the discovery of the pricing is
absolutely.
Done. Okay,
So thumb rule, all the SPVs we've sold have roughly gone at about 6 crores a megawatt. Okay. And typically, when you sell a turbine, a turnkey turbine in India, for the existing platform of 2 megawatts, it's about approximately 6 crores. Now, someone may pay 5.9, someone may 6.15, but give or take 5%, we'll be at approximately 300 crores for the last SPV.
Okay, can you tell us a little bit about the ordering activity as well? What's the trend that you're looking like across wind projects, and what kind of order visibility do you have for the next 1 to 2 years?
Look, I'll talk about wind first and then I'll come to green. So, sure. I think we're seeing the sector coming back very, very strongly after almost 4.5 years of a very painful transition from feed-in tariffs to auctions. We are very, very bullish. I think all the 3 segments of the market, which is IPPs, public sector enterprises, and the retail captive third-party market, I think all of them are firing on all cylinders. The larger goal obviously is 500 gigawatts by 2030, of which wind is 175 gigawatts. And we're presently at 42 gigs. So we're really talking of 4xing the sector, or 16 gigawatts per annum. Now, whether we achieve 40% of that target or 70% of that target, the sheer numbers are massive. And I think what's also happened is after the whole painful transition, there's been significant consolidation in the OEM segment. So from an Indian context, we probably have just 2 Indian OEMs who've survived and maybe 2 or 3 foreign OEMs. So we've already almost seen 30 OEMs go bust or exit the sector. It's become a seller's market. I think naturally inventory issues have been cleared up. So people are now going to make turbines and sell turbines only to make money, not to make losses, frankly speaking. Secondly, I think there's also been a significant realization that tariffs need to be realistic. This is not a lottery system where someone bids 3, you make it 280, then 260, then 250. You make it free, you're never going to be able to make a return. So I think we've seen tariffs now stabilize at about 2.8 to about 3.1. And I think around 3 rupees is where tariffs really need to be to give reasonable returns to IPPs, also get lenders to lend to these people, and obviously as OEMs, us be making money. And I think we're seeing significant traction and logic prevailing now in all the auctions.
The reason I was asking you about the ordering activity is because, you have seen this sharp escalation in raw material prices. So there was a big drawdown in the renewable energy space in terms of fresh orders. You think that is still a concern, and what do you see as the way forward?
So I think on the wind side of things, yes, there was a significant jump. But frankly speaking, all of us had inventories which had to be cleared up when the sector shut down. So frankly speaking, those came in at X price and not, say, 1.2x price. So we kind of absorbed that, got rid of that across OEMs who survived, took the hit. I think where people have faced a lot of heat is on the solar side of things. Because, panel prices went from, say, 30 to 25 to 20. And people were, it was like a lottery system, as I said. People were expecting to be at 18 cents. And they were bidding on that basis. And on the contrary, it went up to almost 28, 30 cents a kilowatt. So frankly speaking, I think we're seeing a significant hit on solar installations in India. I think on the wind side of things, the sector's only coming back now. And I think, as I mentioned, people who survived, they're just strong. They're getting stronger. For example, ourselves now, post this IPO and the promoter infusion, we're aiming to make the consolidated wind business a net debt-free entity in the near future. And I think, it should bode very, very well for us to capture the growth which comes up in the sector as we move forward.
Devansh, a number, please. What percentage of your orders on hand is currently dependent on your parent, Inox Wind?
So let me just explain what we do at Green. So we are doing O&M services. Now we have a 3 gigawatt fleet, approximately 3 gigawatt fleet already contracted at the Inox Green level. So that has nothing to do with Inox Wind. Now this 3 gigawatt is a long-term annuity business operating at almost 50% EBIT margins. And these have built-in escalation clauses of approximately 5% per annum. So to that extent, Inox Green, God willing, will keep making these revenues and growing with the built-in escalations for the, say, next 20 years. That's number one. What we have with Inox Wind in terms of, we have a synergistic exclusive relationship wherein whatever turbines Inox Wind sells, those O&M contracts come into Inox Green. And presently, Inox Wind has has an order book of approximately 1,300 megawatts, which as and when it keeps executing, those orders will come into Inox Green for further growth. And thirdly, at Inox Green, we're looking at significant inorganic growth opportunities. So, when the sector shut down, we've got almost 12 gigawatts of fleet out there out of the 42 installed fleet in India. And this 12 gigawatt of fleet is where OEMs have gone bust or exited. And these are all primarily being serviced by unorganized players. So we are extremely focused and bullish about acquiring a significant chunk of that play in the market.
If you look at the last 3 years, right, I'm just talking about pure financials, your revenues have not grown. I mean, between FY20 and FY22, it's been largely flat between 160 to 170 crores. So that's where I think the street is a bit disappointed as well. The stock is down almost 9%. What kind of revenue growth can you eke out, say, over the next 1 to 2 years? Will it be in single digit? Are you looking at double digit?
Look, frankly speaking, we've grown this company at a CAGR of 40% since inception over the past 9 years. And this includes the period when the sector shut down, including the past 4 years, right? When the sector was going through a painful transition. And then, of course, COVID came in for the past year and a half. Now, if we exclude that, we'll probably be growing at about 60%. So, yes, I am well aware of the fact that for the past 3 years, our revenues have typically gone up by only about 10%, which translates to about 150, 200 megawatts of capacity being added. That's primarily because for the past 2 years, thanks to COVID, for almost a year and a half, we were doing nothing. We were just surviving, waiting for the good days to come. And about a year was the transition pain. So for the past 2 to 3 years, you've really not seen anything happening in the sector except people going bust and us trying to survive. I think, what is important is, I think the painful period is over. In the sector, the transition is completely behind us. COVID is, if I may, God willing, say so, behind us. I think we're very bullish about the growth opportunities, and I think that's also going to get reflected at the Inox Wind level, where you are going to see significant traction in terms of top line and profitability as we move forward. And you'll also be seeing a couple of acquisitions being announced at the Inox Green level in the near future.
No, I take that point entirely. I mean,
I think the stock price.
No, of course, the stock price is a function of the market, right? It has nothing to do with you running the business. Running the business is your job. But I take your point entirely. I mean, this has been a very tough last couple of years, and just survival in a market like this is a big deal. But yeah, I think Rima has one follow-up question.
Just one final question. Do you think you will be profitable?
Sure.
In Q1, you made a loss.
So, Rima, I won't give forward-looking statements, but God willing, with the new financial year, we will be profitable for always. For all times to come.
So FY24 will be profitable, right? That's the new financial year you're talking about?
For sure.
Okay.
For sure. For sure.
You're not committing about this financial year, but we'll leave it.
So we clean up all our debt. So once we clean up the debt,
okay.
As you know, we operate at about 50% margins. And all of that translates into profitability, given that there is zero capex in this business.
Okay. All right, Devansh, we leave it at that. All the best, and thanks a lot for joining in. That is the listing of Inox Green. It's been a disappointing listing, but the wind energy sector itself has been in the doldrums for a while, and now things are picking up, they say, in green energy as well, and they're looking to become debt-free. As of now, they're left with 420 crores of debt post the IPO, and the sale of the last SPV will happen soon, and then they're looking to become debt-free. But moving on, the Supreme Court has rejected Tata Power's plea challenging 7,000 crores of MERC contract to Adani Power. Ashmit is here to give us the details. Ashmit, over to you.
Well, this is a big relief for Adani Electricity coming in by way of a ratification by way of the Apex Court. Just to give the background to our viewers, let's keep in mind that in March of last year, which is 2021, when the MERC, the Maharashtra Electricity Regulatory Commission, had awarded a transmission contract worth 7,000 crore rupees to Adani Electricity. Now, Tata Power had subsequently challenged that in APTEL, arguing that there had been no formal bidding process, and therefore this means of allotment, this award of contract, is not a valid contract, and that needs to be set aside. Adani Power, however, has said that MERC had acted within the purview of the existing legal domain, and therefore there was no requirement to set aside this order. subsequently. But Tata Power had challenged this before the apex court. This very same question was raised on whether or not such an award of contract of this magnitude can be done without a formal auction or bidding process. The Supreme Court, however, has held that again, MERC's actions were dictated by Section 62 and Section 63 of the relevant act, by the relevant provisions, and therefore there was no room for argument that was being made by Tata Power, and therefore Tata Power's application was set aside. What this does effectively is that it paves the way for Adani Electricity to take charge of this contract that was awarded in March of last year, has been challenged across various forums, and therefore now gets finality before the top court.
Thank you very much, Ashmit, for providing that important update to us. Need to get into a break. As we do that, here is a quick programming note. To fully commit to the cause of bridging the gender parity gap at the workforce, CNBC-TV18 is all set to lead charge with a one-of-a-kind mega initiative, Future Female Forward, the Women's Collective, presented by HSBC. The initiative will be officially launched through an exclusive on-ground event on Friday, November 25th, in the presence of Shireen Bhan, Managing Editor, CNBC-TV18, Mr. Hitendra Dave of HSBC, and other women leaders of India Inc. Also in attendance will be some of the most influential voices from business, entrepreneurship, and entertainment. Don't forget to tune in to CNBC-TV18 on Friday, 25th November, 5:30 p.m. onwards. Welcome back. Let's talk about the markets as we speak. We're almost at that 18,300 mark. It's a steady session, but pretty quiet, just a gain of close to about 0.2%. But what do you do from here on? What is the positioning in the market? Vinod Karki, the head of strategy research at ICICI Securities, is now joining in. Vinod, morning. The overall global setup appears to be improving or stabilizing at least. Commodities have seen a decline, whether it's base metals or even crude prices are now at $87, $88 per barrel. The earnings picture has not been bad. Financials are showcasing the best return ratios in close to about a decade. Is this all priced into the markets at 18,300, or do you see a lot of upside from here on?
Yeah, thanks, Rima. So I think if you remember, the market was significantly lower at the height of this, when the Ukraine-Russia conflict and inflation was spiking significantly. And there were talks of the market going even below, below those 16,000 levels. But from there, we have seen a bounce back. What is happening is market is reaching a fair valuation kind of environment right now. Because the big thing that has changed since over the last 6-7 months is that we were talking about a 60s to 80s kind of a spike in interest rates in the US. So that scenario is slowly fading out, where now the inflation number seems to be, peaking out, and there are talks that the next year, the Fed will be in a better position to slow down and even cut if we at all fall into a recessionary environment. Last year, the problem was that the Fed was at close to zero rates, and there were chances of a recession already, basically. So there was no ammunition with the Fed to fight any kind of a significant slowdown, if at all it came by. But now, with terminal rates at 4.5% to 5% after the few hikes that they might do further, the Fed will have enough ammunition to cut rates if at all we get into from inflation to actually sharp fall in inflation and recessionary kind of environment. So I think from an equity valuation perspective, this change in environment puts a floor on valuation, which had seen a significant contraction because it's a direct relationship. The rates go up, the equity valuation starts contracting. So that contraction in equity valuation environment is slowly fading away, in my view. So that sets a floor for valuations. But having said that, the movement in market prices seems to suggest that we are reaching a fair valuation, and further increase in stock prices will be only driven by earnings growth, whatever they come by, the double digit, mid double digit, or something like that. So equity valuations equity prices could follow earnings growth from here on. I don't think there is a scope for valuation, either contraction or expansion at this point in time.
Okay, got that. I also wanted to talk a little bit about some of your stock ideas. You are very bullish on your top stock picks include names like Ashok Leyland, there is Ultratech Cement, there is Sapphire Foods. A lot of these are the domestic consumption plays, right? Whether it's auto, whether it's QSR. Do you think this is the way forward? I mean, as a part of your portfolio, is it prudent to sort of be bullish on the domestic consumption story?
Yeah, if you look at our orientation, we are more bullish on the domestic investment cycle and the credit cycle, along with a bit of discretionary consumption. So what is coming out clearly is that the whole GDP expansion is being led by the investment cycle, and now we are also seeing credit cycle pick up along with industry credit picking up. And the consumption basket, if you see, it is getting into a dichotomy where high-end discretionary consumption is showing very robust patterns, whereas the mass consumption categories are showing sluggish, kind of demand. And it has to do a lot with the income profile of the people who consume these products. So that's where the dichotomy is coming from. So broadly, if you look at where the demand is arising in the economy, it's largely from the investment side of the economy, be it construction, the whole real estate cycle, the power utilities, now telecom also looking good after the recent tariff hikes, that they will be able to invest. And metals and commodities, others have already announced a lot of investment activities, while the investment in digital infrastructure, equipment and all, we are seeing a lot of announcements anyways. So I think it's a broader investment cycle which is picking up. Initial signs are only through the announcements that we have heard, that the conversion from announcements to actual flow into the balance sheets and cash flows of companies, order books and all will take some time. But it's showing up in terms of industry credit picking up after a decade, and a lot of things, the real estate itself, which is a significant part of the gross fixed capital formation, showing traction. Yeah.
Vinod, do stay on. Need to get into a break. We'll come back and continue this conversation. Welcome back in conversation with Vinod Karki of ICICI Securities to talk about the markets and the way forward. Vinod, once again, now the debate has opened up whether we should be investing in equity markets per se, because debt as an option is also turning out to be fairly lucrative. As you said, valuations have reached fair levels. There perhaps cannot be much upside in terms of a valuation re-rating. Now that return ratios on the debt side, fixed income is getting better, would you recommend allocating money to debt over and above what you're doing in terms of equity, or take away some of your equity investments and put in debt now?
Yeah, from an asset allocation perspective, it's a good signaling that if equity markets start reaching fair valuation and bond yields are reasonably high, it's a natural, asset allocation that you start moving some of it to debt. So I don't think that would be a very that would give you any bad outcome. But as we have seen, in an environment where the economy might be driven by investment and credit cycle, some of these, these cyclical companies can significantly outperform, And so from a portfolio orientation, if you move towards those kind of stocks, you could get much higher return. But on an overall market basis, where the defenses won't do much, the expensive, low volatility quality stocks might not do much outperformance. Overall, I think there is a good scope for this kind of asset allocation to do, basically, as we reach more than fair valuation.
Okay, all right. We'll leave it at that. Thanks a lot, Vinod, for joining in, and have a great day. That's the word coming in from ICICI Securities. We leave the markets absolutely quiet. Nothing much has happened since we started the show. But don't go anywhere. Halftime report is coming up next. It'll take all the market action for you.